Heather Merriman with Ninja Retirement Solutions, and welcome to this little nugget of information that we have for you today. I want to talk to you about the 3 buckets of money that you are basically going to be filling up over the course of your working years in the process of reaching your retirement funds. So the first bucket that we're going to talk about is going to be what I call your taxable bucket of income. Now this is going to be your most liquid money. So now we're talking CDs, money market accounts, mutual funds, stocks, bonds, things of that nature. Now most of you are well aware that the amount that we are typically advised to keep into that taxable bucket is about 6 months of your living expenses. So obviously, you know, that's going to vary for everyone, and your financial goals are going to need to be specifically developed for you and your needs and your goals. Now, that being said, each of the buckets do have a purpose and an amount that you want to keep it at a level at, because having too much or too little in any of your 3 buckets is going to be very detrimental to how long you'll be able to use those funds through your retirement and how long they're going to last for you. So the second bucket that we are going to talk about is going to be your tax-deferred bucket. Now, the most common types of investment funds that people will typically have within that bucket is going to be your 401ks from employers or your personal IRAs. Now there are a few other smaller, more specialized types, but the most common is going to be your 401ks and your IRAs. Now that bucket is the bucket that you're using to accumulate money during your working years. Now, what's important to keep in mind here is that you are basically almost going into business with the IRS here. Why do I say that? Because this bucket is tax deferred, meaning that you are making an arrangement with the IRS that you are not paying money or taxes on those investment funds today, and you're not going to pay it until some future time. At some point in the future, when we don't really know what your tax rates are going to be. So that's your unknown factor. So you get the benefit, the IRS is letting you have the benefit of growing and accumulating that money tax-free, but the drawback is later on they are going to get their cut, and if time is on their side the way that they anticipate it, then they're going to end up making more money in taxes because the tax rate will be higher than when you first put that money into that bucket. Now, that being said, we've got the third bucket that we do want to look at for where you want to have investment funds. So that third and final bucket is going to be your tax-free bucket. Now, that is going to be huge. Why? Because something that is a very common goal for future retirees is to get into a tax-free bracket. Why? Well, the more of your money you get to spend on you and not give to Uncle Sam, the longer that money is going to last you, and the closer it's going to get you to living the type of lifestyle that you are planning and dreaming of. So what can go into your tax-free bucket of income? Well, that is going to be your IRAs as well as life insurance policy and investments as well. Both of those have their pros and cons, and that money is money that's going to be very strategically used to offset your taxes and allow you to live a tax-free retirement. Now, some of the drawbacks to an IRA is going to be you have very strict limitations as to how much you can put there. So, you know, the IRS doesn't want you to get that bucket too big because, you know, they're still wanting their type of a cut. So they do with IRAs give you strict limitations. Now, life insurance does not have those limitations. It's much more gracious in how much you can invest into that bucket through that means. Another perk that's quite helpful and kills more than one bird with a single stone with life insurance is not only will it put you into some more funds with the tax-free bucket, but in most cases, you can also have riders built into your life insurance that will cover the expenses of long-term care, which again, also something you don't want to plan for your retirement, but if that event should happen, at least then you will not be completely draining all of your investment funds. So again, we have 3 buckets that we want to maintain our focus and attention on throughout your entire working career. Plan when we want to spill from one bucket to the next. Again, there are buckets we don't want to get too full or too depleted. And those 3 buckets, again, are your taxable buckets, as well as your tax-deferred bucket, and finally, your tax-free bucket. So stick with me to find out more about why each of these buckets are important to you and all of your goals, and how to utilize the best tools to optimize these buckets to their fullest potential for your goals as we move forward. Be sure to hit that subscribe button and find out more. And don't forget, email me at heather@ninjaretirementsolutions.com. I look forward to hearing from you.